Okay, so the topic tonight, class, would be installment sales method. This is one of the multiple revenue recognition methods that we'll be discussing in this subject. So we've grown accustomed, class, to what we've been discussing before, wherein revenues are recognized the moment they are earned, or normally they are recognized at the point of sale. It does not matter, especially under accrual, it does not matter when the collection will ultimately happen. It does not matter that the collection will just be on year 4, year 5, so on and so forth. The moment there is already a transfer of the risk and rewards over the goods that we are selling, we will already be recognizing the revenue and the related cost. Okay? And here comes your installment sales method, class, which is an alternative to the point of sale method. Under the point of sale method, regardless of when the collection happens, the revenue is recognized at the point of sale. The moment there is already delivery or transfer of the risk or and rewards over the asset sold. Now, supposedly we will be using the installment sale method, class, if you're of course you're engaged in installment sales, meaning the collection happens in a longer period. You will be using the installment sales method if you sell on account, if you give credit to your customers. Okay, but it does not mean, class, that if you are engaged in installment sales, automatically you should be using the installment sales method. Even if you are engaged in installment sales, even if you give, if even if you sell on account, you can still use the point of sale method. When then are you supposed to use the installment method or the installment sales method? If there is a significant doubt as to the collectability of your receivables. The problem with the point of sale method, class, is that if your collection will eventually not happen, you will have large amounts of revenues at the point of sale, but at the same time you will have significant amount of losses as a result of default, as a result of failure to make collections. So to remedy that, class, we have the installment sales method, wherein the gross profit or the revenue will only be recognized, will only be reported when there is collection. So the installment sales method is really more conservative. You only recognize profit if there is already collection. And that is why we are supposed to use the installment sales method only if, based on experience, there is significant risk or there is significant doubt as to your ability to collect your receivables. If, based on experience, class, your customers, a significant portion of your customers will default, will not pay the installment balance, then you should be using the installment method. Again, just to emphasize, class, it does not mean that if you're engaged in installment sales, automatically you should be using the installment method. You should be using the installment method if there is significant doubt as to the collectability of your receivables. If there are a material amount of defaults coming from your customers. If not, if a big portion of your customers do not fully pay the balance. Okay? And again, main distinction. Under the installment sales method, class, revenue recognition is driven by collection. If you do not have any collection, then you will not have any realized gross profit. Under the point of sale method, regardless of when the collection happens, the revenue and its related costs will immediately be recognized at the point of sale. But again, under installment sales method, revenues will only be recognized when there is collection. Okay, and which leads us to the most common question for this topic, class. The most common question is to compute for your RGP. Okay, RGP stands for realized gross profit, and this is the most common question for this topic. How much is your realized gross profit? And before we discuss the problem in the textbook, I want to emphasize first, class, that your RGP is very easy to determine. You only need two things to solve for your RGP. You only need your gross profit rate which you will multiply with your collections. Okay. The problems have a lot of ways in complicating the computation of your RGP. Okay, but I do not want you to develop the notion, class, that this topic is difficult. Okay. The most common question for this topic again is just your RGP, and you only need two things to solve for your RGP. You just need your gross profit rate and your collection. But why would many students think that the installment sales method is a difficult topic when the most common question requires only two things? It's because you do not expect these two to always be given. Yes. But I want to emphasize at this point that as long as you have these two, the computation of your RGP should not be difficult. You only need to determine your gross profit rate and your collections. Once you have those two, you can already solve for your realized gross profit. Okay. There are a lot of ways wherein the problem can make the determination of your collections difficult. The problem can include multiple years with different gross profit rates. The problem can use percentages. The problem can test your understanding of the English language in knowing how much is to be collected. Okay, and the problem can also include interest and sometimes penalty in the collection. Okay, in this formula class, the collection pertains only to the principal receivable balance. So if your collection includes interest and some other amounts, you should remove those amounts in determining your collections to be multiplied with your gross profit rate. Okay, but before we go there, I want to emphasize that the most common question here is to compute for RGP. And to solve for RGP, you only need two things, your gross profit rate and your collections. In most instances, the challenge would be in the determination of your collections. Okay? We do not expect collections to be given. We also do not expect the gross profit rate to be given, class. Okay? But there are problems that give you outright the gross profit rate, but it should not be a big problem if the gross profit rate is not given. You're expected to know at this point, class, how to compute for the gross profit rate. And I hope you'll be able to understand why I have given gross profit a significant importance at the start of the semester, class. Okay? How do we solve for the gross profit rate? Gross profit rate is equal to your gross profit over your sales, or your installment sales in this case. Okay? And this is not the first subject you have encountered gross profit rate class. So you're expected to know how to compute for gross profit rate. Okay, and what do you need to solve for your gross profit rate? You just need your gross profit and your installment sales. Normally, installment sales will be given. Okay, sometimes gross profit will not be given. You will be the one to solve for gross profit. And just imagine, class, if at this point you still have problem computing for your gross profit. And supposedly that's just the first step before we go to the main event class. Okay? And that is why, again, it was very important for me that it's clear to you at the start of the semester that you should already know how to solve for gross profit. Because the challenge is supposed to be in your collection class. Okay, but if your problem is still at the gross profit, then you will have a lot of problems. Okay? You would need the gross profit to solve for your gross profit rate, and you need your gross profit rate to solve for your RGP. Okay? Our challenge should just be on the collection class, because sometimes it would be a test of our understanding of the English language. Okay? But if you still have problems in computing for your gross profit, then your problems when you solve for RGP would just be compounded. Okay? And again, how do we solve for gross profit? It is simply the difference between your sales and your cost of sales or your cost of goods sold. Okay? But again, let's go back to the basic class. What's the most common question for this topic? Compute for RGP. And what are the two things you need to solve for RGP? You just need your gross profit rate and your collections. Okay, you only need two things. Now let's try to apply this. Installment sale was 1 million, and then collections will happen in the next 4 years. So the first year we are able to collect 400,000. Year 3, 300,000. And on the last year, we will be collecting 100,000. And the gross profit rate class is 40%. So the question now would be compute for the RGP for year 1, 2, 3, and 4. I'll give you 10 seconds to solve those 4 items. So for year 1, our RGP would simply be 400,000 times 40%. So your RGP would be 160,000. Okay. Next would be RGP for year 2 would simply be 80,000. Okay, that's 200,000 collections times 40%. For year 3, our RGP would be 120,000. Okay, that is simply 300,000 times 40%. And then for year 4, it would be 40,000. 100,000 collections times gross profit rate of 40,000. And you already solved 4 problems already. Okay? But why are the problems not always this easy, class? Because the problem will not always give you outright the collections and the gross profit rate. But I want you to understand, as long as you have the gross profit rate and your collections, the computation of your RGP, the most commonly asked question should be very easy. Okay. Now let's say, for example, the gross profit rate will not be given. If the gross profit rate is not given, what do you expect to be given? You should be given with the cost of sales or the cost of goods sold. Okay. Let me change this to okay. So questions would be compute for the RGP for year 1, 2, 3, and 4. What are the 2 things we need to solve for RGP? We need to solve for the gross profit rate and your collections. Are collections given? Yes. So the only thing lacking would be our gross profit rate. So if our installment sales is 1,200,000 and our cost of sales is 900,000, that means we have a total gross profit from this transaction amounting to 300,000. And if your total gross profit is 300,000, then that would mean that your gross profit rate is 25%. How did we get 25%? 300,000 divided by 1,200,000. Okay. Now let's solve for the RGP this time. Okay. Your RGP for year 1 would simply be 400,000 times 25%, which will give you 100,000. Then your RGP for year 2 would be 300,000 times 25%, and that will give you 75,000. And then your RGP for year 3 will just be the same because you have the same amount of collection. So this would also be 75,000. Okay, still 300,000 times 25%. On the fourth year, it would simply be 200,000 times 25%. That will give you 50,000. Okay. Now, what will happen in problems class? Sometimes you'll be asked for the RGP for year 3. But what happened in year 3? In year 3, you had collections from year 1 sale. In year 3, you also have collections from year 2 sales. For year 3, you will also have collection for your year 3 sales. So meaning your total collections for year 3 will come from 3 sources. From the sales in year 1, year 2, and year 3. And in most problems, you cannot just add all your collections for year 3 because the gross profit rate for year 1, 2, and 3 are not the same. So you will have to determine how much have you collected in year 3 from your year 1 transactions. How much have you collected in year 3 from your year 2 transactions? How much have you collected from your year 3 transactions in year 3? Okay, you will have to individually identify your collections, whether they came from year 1, 2, and 3, and multiply them with their respective gross profit rate. You add all of them together, then you will now have your total RGP for the year. Okay, again, but as long as you have your gross profit rate and your collections, the computation of your gross profit rate, your RGP should not be difficult. Moving on, class, the second most commonly asked question for this topic, which is your DGP. DGP stands for Deferred Gross Profit. Plus RGP is an income account. Okay? Well, the DGP is a liability account. This is an unearned income account. This is a deferred income account, meaning this is a liability. As what I've told you, we will be encountering a lot of deferred income accounts or unearned income accounts. And I want to bring your attention, class, to the fact that your DGP essentially behaves the same way as your allowance account. Okay, diba? Your beginning allowance is just the markup on your beginning inventory. Your ending allowance is just the markup on your ending inventory. Your DGP class is the same. This is just a gross profit, or in other words, this is just your markup. Okay, but since it is deferred class, meaning it is not yet earned. Okay, and under the installment method, what is the earning process? The earning process is through collection. So what then does your DGP represent? It represents the markup or the gross profit on your uncollected receivables. Okay, so anything that is not yet earned will go to your DGP, and what are not earned, those that are not yet collected. Okay, and what will happen if there are collections? Then you will have to make adjustments from your DGP. They should be removed from your DGP. What should remain in your DGP is the portion of your gross profit that is still unearned. Okay, meaning those that are not yet collected. Okay, now in this contract class, how much gross profit are we expecting in total? 300,000. Under the point of sale method, the entire 300,000 would have been recognized on year 1. But what do we do under the installment method? We wait for collection. If there are no collections yet, what will happen to the expected gross profit of 300,000? It will remain as a DGP. Okay. So again, how much are we expecting in this? How much gross profit are we expecting in this contract? 300,000. Before any collection, the entire 300,000 will be considered unearned. Okay. Now, what happened in year 1? We were able to collect 400,000, which led us to realizing or earning how much gross profit? 100,000. How much total are we going to earn in this contract? 300. How much have we already earned as a result of the 400,000 collection? 100. So how much is not yet earned? 200,000. So this is now the second most commonly asked question. How much is your DGP? It's just actually common sense. The contract will give us a total gross profit of 300, and you have already earned after year 1 100. So at the end of the first year, your DGP will have a balance of 200,000. After year 2, how much will be the balance at the end of year 2 of your DGP? It would be 125,000. Where did we get 125,000? By the end of the first year, the remaining unearned profit is 200. How much have we earned or realized additionally during year 2? 75. So how much remains unearned? 125. 75 minus 200. Or if you want, you get all your cumulative RGP and deduct it from the 300. After year 3, how much would be the balance of our DGP? It will now just be 50,000. How did we get the 50,000? By the end of the second year, the unearned profit is only 125. And we were able to earn additional 75 on the third year. So by the end of the third year, the amount that is still unearned is just 50,000. Okay? And by the end of the fourth year class, since it was fully collected, our DGP will now be 0. Okay? And these are now the two commonly asked questions. This will be worth 8 points already. Okay? Third commonly asked question, class. How much is the balance of your installment receivable? Okay? What will be your entry when you make the sale, class? Debit, installment receivable, and credit, installment, sales. What will be your entry when you make a collection? Debit, class, collection, debit, cash, and credit, installment, receivables. So every time you make a collection, class, your installment receivable will decrease. The moment your installment receivables are fully collected, then that means your installment receivable will be 0. Okay, so third commonly asked question, how much is your installment receivable at the end of the year? So let's start with year 1. How much would be your installment receivable at the end of year 1? 800,000. Where did we get 800,000? Initial receivable will be 1,200,000. How much have we collected on the first year? 400,000. So the remaining balance of your receivable will be 800,000. Year 2, how much would be the balance of your installment receivable? 500,000. Because it was just 800 after the first year, and you collected how much on year 2? 300. So remaining receivable will be 500. Is this clear?
Yes.
Next, year 3, you made another 300,000 collection, so that means the balance of your receivable will now just be 200,000. And what did you do in the fourth year? You collected 200,000. So the balance of your receivable will now be 0. Okay? And this is not something new. This is how your receivable works. It will be increased by sales and decreased by collections. Okay? We started at 1,200,000, which was our installment sales, and then we deduct the yearly collection. We ended at 0 because we were able to make full collection. Okay, but this is what I want you to notice, class. Again, these are now the 3 commonly asked questions, class. RGP. What do we need to solve for RGP? Gross profit rate and collections. DGP, you just have to analyze it, class. Okay? You base it on the initial or the total gross profit expected from the contract, and you just deduct all your realized gross profit. The same for your installment receivable. You start at the initial installment receivable, which will be equal to your installment sales, and you just deduct the collections. Here, what are we deducting here? We are deducting RGP. For your installment receivable, what are we deducting? We are deducting your collections. So I hope you are able to understand that there is a connection between your DGP and your installment receivable, which is what I would now want you to focus, class. You can get your DGP, class, based on your installment receivable. What do I mean? Your DGP is actually just, what did we say about our DGP? It's the unearned profit in our uncollected receivables, correct? So you can actually solve for your DGP, class, by using your installment receivable and multiplying it with your gross profit rate. How much is our gross profit rate in this example? 25%. So you multiply the 800,000 with your gross profit rate. 800,000 times 25% would still give you 200,000. And then, how much is your installment receivable at the end of the second year? 500,000. Multiply that by 25%. That should give you 125,000. Installment receivable at the end of the third year, 200,000 times 25%. DGP after year 3 would be 50,000. And of course, 0 times 25% will just be 0. Okay? And that is why, again, I mentioned that your DGP is very similar to your allowance. Diba your ending allowance is just the markup on your ending inventory? Your ending DGP class is actually just the markup or the profit in your receivable. Okay? And the problem now, class, is that what do we need for RGP? Collection and gross profit rate. How can we solve from our How can we solve for our DGP using the installment receivable? Installment receivable times gross profit rate. And how do we normally get our installment receivable? Based on collection, which is used also in RGP. And that is why problems will just work around the connection between these things, class. Okay? But again, that is not based on the difficulty of the topic, class. The topic is very simple. RGP, collections times gross profit rate. DGP, installment receivable times gross profit rate. Okay, we only need two things for most of these questions. It's just that these items will be withheld by the problem class. Okay, the problem will challenge you since both require or will use collection, then collection will be hidden, or only one of them will be given class. The challenge really on your part will just be to arrive at the two things that you need to solve for the question that is being asked. Okay? And we'll now try to solve problems in the textbook that will focus on these items lang.